The bank account is an important tool we can use to protect cash. Cash being the most liquid asset, it's easy to conceal, easy to move, and relatively easy to steal. Hence, there are some obvious advantages to having a bank account. First, a bank has established practices for safeguarding cash. A bank is usually much more equipped to safeguard a customer's money than the customer. But because this is an area of expertise for the bank, which the average person does not have, the bank tends to be a lot more successful in keeping money safe. Next, we have detailed records of transactions. A bank typically provides accurate and up-to-date information for deposits, withdrawals, and other transactions. The documents used to present this information and control a bank account, a key element in a business's internal controls. Some documents used to control and monitor a bank account are signature cards and electronic signatures on file. Banks require authorized persons in a business to sign a signature card, which is then uploaded into the computer system and used to verify identity in future transactions. Deposit books or slips. Banks apply standard forms such as deposit slips and deposit books. These are used by businesses to keep track of deposits. Checks. To pay from a bank account, a business writes a check. This is a document which instructs the bank to pay a specific company or person a certain amount of money. There are three people or organizations involved with every check. We have the maker, the person who signed the check. So if you have a checkbook and you write someone a check and you sign it, you are the maker of the check. The payee, to whom the check is paid, so whoever you gave your check to, that's the payee. And the bank on which the check is drawn. So whoever you bank with, every time you hand out a check, the bank is also a third party in that transaction. A modern day alternative to a check is an electronic funds transfer, short form EFT. An EFT is an electronic transfer of cash as opposed to using a check. This can be easier, safer, and cheaper than writing a check. Debit cards are one method of completing EFTs. Banks often send monthly statements to their customers. This is a summary of what the bank did with the customer's cash. A bank statement shows the account beginning and ending balances for that period and lists cash receipts and payments transacted through the bank. The maker's canceled checks, which have been cashed by the payee, are also included. Bank reconciliations. A bank reconciliation matches up the cash amount shown on the bank statement with the cash amount on the business's accounting records. Due to several factors, which we will discuss below, the two amounts rarely match up at a given time, so bank reconciliation is necessary to investigate differences. This is called a bank rec for short. Before we go into how the bank rec is prepared, let's first familiarize ourselves with the documents which provide us with the necessary information. Assuming we are preparing a bank rec on a monthly basis, this is a common practice since banks and other financial institutions typically mail out monthly statements. We are interested in our own cash records at month end and the bank's monthly statement. Let's use the SFU bookstore as an example again. Here are its cash records on September 30th. So first and foremost, you see here the general ledger. It's for the month of September. So we have a bunch of things happening in September. And every time we have a cash receipt, as expected, we see a cash balance going up. The cash payments have been moved in to this table in bulk. So the cash payments are coming from the cash payment journal. And we have 4 checks, which add up to $3,873.90. The last of the month, we subtract this amount off from our general ledger cash account. And at the very end, we're left with a balance of $3,208.60. Now, as mentioned, we need a second half of data, and that will come from the bank statement from our bank. So the SFU bookstore has a bank account at the Bank of Vancouver, and we have a statement from September 1st to September 30th, and this is the data given us by the bank. So the idea here is we're going to see a lot of items which we already know about in our books. We won't see all of the items. So there'll be something that the books are missing, and there'll be something that the bank statement is missing. Under normal circumstances, when completing a bank rec, you would go back and forth. So you would check off the similar items from here, which show up over here, and everything that doesn't match up will need to be reconciled. So this will be a practice that you will do in your assignment, but for the purposes of these notes, I will organize everything for you. So we'll get to that actual bank rec a little bit later. First, let's talk a little bit about the process of completing a bank rec. The first thing we notice about the bank statement is that cash balance does not match the bookstore's records. As noted earlier, it's an expected phenomenon. Differences arise because of a time lag in recording transactions. Call it timing difference. So a good example of this is when you write a check. When companies write a check, they immediately deduct the check amount from their cash account balance. However, the bank does not deduct this amount from the company's account until the bank actually pays out the cash. This can be days or weeks, depending largely on when the payee actually cashes the check. So you might write somebody a check last week, and you would take that cash out of your balance, as you rightfully should, but it's out of your control when the payee will actually take the check to his or her bank. And it might not be this week, it might not be next week, it might be a month from now. So when that whole transaction is completed and the money is transferred out of your account, that's when the bank has that up-to-date record of your check actually been written and paid out to the payee. When companies receive cash and make a deposit to their bank, either via check or cash, they immediately add the cash receipt amount to their cash account balance. However, it may take the bank a day or longer to add the deposit to the company's account. So let's say that you receive cash from a customer on Friday afternoon, and after work on Friday night, you drop it in the bank mailbox on your way home. Well, it might be a long weekend, so the bank would not be open on Saturday, Sunday, or Monday. So your cash is deposited at the bank. You've updated your cash records, your books, but you won't actually see the deposit in your online banking account until possibly Tuesday. So that's an example of a timing difference with a deposit. The timing differences when it comes to deposits are not as severe as checks, simply because you have some control over when you give the money to the bank. With checks, you really have no idea or say in how long it will be before the payee deposits the check at the bank. Third point, any EFT payments and cash receipts are recorded by the bank before the company learns about them. So again, EFT is direct transfer to your bank account. There might be instances where you have an automatic payment set up you don't really keep track of. You should keep track of it, but you don't. So you record it when the bank statement comes. You might also have customers or other parties transferring you money without telling you. So you would see that when you get the bank statement at the end of the month. In summary, the bank rec explains the differences between the company's cash records and the bank statement. It ensures that all cash transactions have been accounted for. It establishes that the bank and book records of cash are correct. To prevent theft of cash and manipulation of records to hide the theft, the preparer of the bank rec should have no other cash duties. So again, we should have separation of duties. Whoever prepared the bank rec should not be the one that handles the cash. So this here is what I like to call the bank rec playbook. Basically, if you look on the left side, you will have the bank side. If you look on the right side, you'll have the book side. And if you go down these two columns, you'll have a really nice idea of how to do your bank rec. This really is a step-by-step process of how we undertake this exercise. So you can see over here, we start with the end of month bank balance. We add in deposits in transit. So these are usually deposits at the end of the month, which the bank hasn't recorded yet. Then we have outstanding checks, which we take away. Now these might not be at the end of the month. They very well could be, but they could also be from long ago because our payee might just not have had the time or the will to go to the bank to deposit those checks yet. And then your bank errors. They could either increase the cash balance at the bank or decrease, but they do need to be corrected. Over on the right side, we have the book side. Once again, we start with the book balance, just like the bank side. We add on bank collections. So sometimes a customer, for example, might go down to the bank and just deposit cash or a check for us without telling us. So that will be a bank collection. EFT receipt. So if we receive money electronically, EFT payment we take away. We have bank service charges. Sometimes the bank will charge a monthly fee or a fee for something else. When we see that on our bank statement, we want to take it off our books. Interest revenue, we might get some money for keeping cash in the bank. And then we have NSF checks and NSF charges. NSF means not sufficient funds. So basically when somebody gives us a check but doesn't have the funds to back it up, the bank will initially add that amount of money to our account. But later on, when the transfer of funds is requested from another financial institution and the money isn't there, then the amount of the check gets taken out of our account again. And we can also have charges associated with that. So the bank might charge us a small fee for trying to cash a check, which ends up bouncing. We have check printing costs, and then we might have book errors, plus or minus, which would need to be corrected. Let's go through some descriptions really quickly. We've already talked about these. Deposits in transit or outstanding deposits. The company has posted these deposits, but the bank has not. Outstanding checks. These checks have been issued by the company and recorded on its books, but the bank has not yet paid them. Bank collections. Sometimes the bank will get its customers to deposit funds directly into the company's bank account. This can save money and also reduce the possibility of theft or error, especially for actual cash payments and large amounts. EFTs. These require no documentation as cash flows directly between financial institutions or even within the same institution, but to separate accounts. Finally, NSF checks. These are checks which turn out to be worthless, commonly called bound checks. It usually results in the original deposit being removed from the company's cash account and a fee also being charged. So let's jump into actually preparing the bank rec. So we'll go through these steps and then you'll try the bank rec and we'll cover it in the next video. So the process starts with two figures, balance per book, the balance of the business's cash account in the general ledger, and the balance per bank, the balance on the bank statement on the same date. So first we deal with the bank side. Add to or subtract from bank balance those items which appear correctly on the books but not on the bank statement. So we add deposits in transit to the bank balance, and we subtract outstanding checks from the bank balance. So the assumptions are, with deposits in transit, the bank will process them in the near future, and with checks, it's also a timing difference. In the near future, hopefully, the payee will go to the bank and deposit their checks. Add to or subtract from the book balance which items appear on the bank statement but not on the company's books. So we have bank collections, EFT, and interest revenue being added to the book balance, and we subtract off EFT cash payments, service charges, NSF checks and charges, and other withdrawals from the book balance. We do a bunch of addition and subtracting on both sides, then we compute the adjusted bank balance and the adjusted book balance. And if those amounts are equal, then we know we have no problem other than timing differences. If we find there to be a difference, then there might be an error that we haven't accounted for yet. Number 5, in the process of doing the bank rec, we might realize that there need to be some entries made to update our books. So we'll make some journal entries in step 5 so that our books reflect the correct amount and correct transactions. And 6, we correct any errors that we can fix, and if we find some bank errors, we notify the bank. So here is the bank rec we will be doing. You'll notice in panel A, I've gone ahead and isolated everything that needs to be on the bank rec, and I'll talk about these items in detail in the next video. And I also have panel B here set up for you, which is the actual bank rec. So I encourage you to go through those 6 steps, go through that little playbook I gave you, and try doing this bank rec. And we will cover it in the following video.